Hello friends, Pakistan, 23rd largest economy in the world by purchasing power parity and home to 230 million people, are now facing a situation of complete economic collapse as the situation is now getting worse. Over the course of the last week, we've seen inflation figures which are now at the highest level for almost 50 years, and two of the rating agencies, Moody and Fitch, have both downgraded Pakistan's status. So in today's video, we'll have a quick recap on Pakistan and the current economic situation. We'll have a look at the latest inflation figures. We'll look at what has been happening with the Pakistani rupee. We'll then have a look at the debt situation and what's going on with regard to IMF negotiations, because Pakistan has been trying to sort out a bailout package with IMF for almost 6 months or so. I'll give you the details of the policy reforms that have been introduced by the Pakistani government in order to try and meet the IMF conditions. And finally, today I'll wrap up with my summary to what I think is likely to happen in Pakistan over the course of the next 3 months. What the implications of this are going to be for the global economy. So before we get started on all of that, if I could ask you for a thumbs up and to please subscribe to my channel if you haven't done so as yet. Pakistan, which borders with Iran, Afghanistan, China and India, and has a coastline on the Arabian Sea, is the 33rd largest country in the world by landmass and 5th largest by population, which has been growing rapidly over the last 20 years. Pakistan does have some natural resources including oil and other natural minerals. However, it does not have enough to be able to feed its own demand, and hence it's a net importer of oil. The country is classified as developing and is a low labor cost economy, with the main industry being textiles. The land in Pakistan is rich and fertile, and 37% of all the population are employed in agriculture, which equates to around 20% of GDP. Pakistan exports a variety of food substances, including sugarcane, cotton and rice, but imports wheat, vegetable oil and consumer foods. The fundamental problem for Pakistan is that it's a net importer. It has to import large quantities of fuel and food from the international markets, and this problem is evident by Pakistan's balance of trade. The balance of trade is simply the difference between the value of all your exports, how much money you're being paid, and the cost of all your imports, how much money you're having to pay. You can see from this chart that in every single one of the last 12 months, the balance of trade has been negative. So that means Pakistan is constantly having to dip into its reserves to buy more fuel and food to keep the country running. If we expand the chart out to show the last 25 years, you can see that Pakistan has been running a negative balance of trade since around 2004. So basically, that means that Pakistan has been funding the economy of the country for almost 20 years on its reserves and debt facilities. Now that's an unsustainable position, because the longer that goes on, the more debt you build up. Therefore, the more interest you have to pay, the problem gets worse. This chart shows the value of the Pakistani rupee against the US dollar over the course of the last 12 months. What this shows is that this time last year, $1 US was trading for 177 Pakistani rupees. However, today, $1 US is trading for 280 rupees when I'm recording this video. So that's a fall of over 56% in the last 12 months. The reason that it is important is that Pakistan is buying all the fuel and food in the international market, which are predominantly priced in US dollars. And as the exchange rate of the Pakistani rupee has fallen, that makes all those purchases relatively more expensive. When they're having to be priced in Pakistani rupees and sold to the people of Pakistan, a 56% fall in the value of currency obviously represents a major problem for Pakistan's point of view. But the problem has been accentuated by the fact that Russia's invasion of Ukraine caused the fuel and food prices to spike in the first half of 2022. So there was a doubling down impact from Pakistan's point of view. The actual prices in the market rose and the value of the currency fell at the same time. So it was a real double whammy impact. If we expand this chart out to show the last 5 years, you can see that the fall in the value of Pakistani rupee has been going on for some time. This time, 5 years ago, $1 US was trading around 110 Pakistani rupees. So that means that the Pakistani rupee today is worth around 2.5 times less than it was 5 years ago. When you combine multiple years of negative balance of trade with a falling currency, that's a recipe for disaster for any country. This chart shows the movement in the rate of inflation in Pakistan over the course of the last 12 months. You can see that in March 2022, inflation was running at 12.7%, which is certainly a high rate, but is not an emergency level. And in April and May, we saw the rate increasing to around 14%. However, in June, there was a big jump to 21%, and that continued in July and August. There was a reduction in rate of increase in prices over the course of the next 5 months. However, the figure for February 2023 has come in at 31.5%, which is the highest for almost 50 years since 1974. You may be looking at these figures and thinking, well, actually this rate of inflation isn't quite as bad as other countries like Sri Lanka and Turkey, so it doesn't seem too drastic. However, a lot of the pricing in Pakistan is actually subsidized. The government is providing subsidies on things like fuel and food to keep prices down, so the actual rate of inflation would be significantly higher if these subsidies were not in place. This is actually one of the issues that IMF has raised with Pakistan, that Pakistan can't afford to be subsidizing all these items, and therefore it wants the government to remove these subsidies. But the government of Pakistan is reluctant to do that because of the impact that it's going to have on the citizens of Pakistan. This chart shows food inflation over the last 12 months, and you can see that there has been a rapid increase over the last 9 months, and the rate of increase of the price of food has come in at about 45% in February 2023. If we expand this chart out to show what's been happening over the last 10 years, you can see that the current rate of increase are significantly higher than any time over that period. And these price increases are a major problem from Pakistan's point of view. Pakistan is a developing country, and there are a lot of people living at or below the breadline. So they're spending the vast majority, if not all of their income on food, and those members of the society don't tend to have any savings at all. When prices are increasing by 45%, that means that they can buy roughly half the amount of food that they were buying this time last year. In situations like this, families get to the point where they simply don't have enough food to feed everybody. The crisis in Pakistan isn't just a financial crisis we're talking about, but people in Pakistan not being able to buy enough food to feed their families is an issue. Pakistan has been funding the economy using debt over the last 20 years, and the total amount of debt has now increased to 62.5 trillion rupees, which equates to around 225 billion US dollars. And this chart provides a breakdown of who's been providing that debt. The 3 different colors here represent the 3 different types of institutions. The blue section on the right represents aid agencies and other institutions that provide support and assistance to emerging and developing countries. The green section comes from other countries, and the pink section are loans from commercial markets. If we look at the blue section first, you can see that the World Bank has provided around 21% of Pakistan's debt. The Asian Development Bank has provided 16%, the IMF 8%, and then there are other institutions that have provided 3%. If we now move on to the green section, you can see that the Paris Club has provided 13%. This club is made up of 22 countries predominantly from the West, including the USA, the UK, Canada, Australia, Russia, and the majority of Europe. The reason that they're called the Paris Club is that all of these countries actually came together in 1956 to negotiate some form of restructuring of Argentina's debt. Now, the other group of lenders here has been called the Non-Paris Club, and that's basically a collective term for everybody else. One of the biggest countries that has been lending to Pakistan over the course of the last 20 years is China. Pakistan actually has had the highest amount of investment from its Belt and Road Initiative. If we now move on to the pink section, you can see that a variety of international banks have provided 13% of Pakistan's debt, and bonds have been issued in Europe equating to 9% of the debt. It's reported that Pakistan has to pay 22 billion US dollars in interest and repayments over the course of next 12 months. And just as a reminder, the current reserves that Pakistan is sitting on are around $3 billion. So that would represent a shortfall of 19 billion US dollars. As a result of that, it's going to have to restructure and renegotiate all of its debt. Data from the State Bank of Pakistan suggests that the country has to repay total debt of 21.95 billion US dollars over the next 12 months. 19.3 billion of that is principal repayment, so actually repaying the debt, and another 2.6 billion represents the interest that's due. The breakdown of the data suggests that 3.95 billion US dollars is due within the next month, 4.63 billion US dollars is due in the following quarter, and just under 13.4 billion US dollars in the last 8 months of the period. As a result of the financial difficulties, Pakistan has been seeking a bailout facility from the IMF, and a $6 billion facility was agreed in 2019. This was subsequently increased to $7 billion in 2021. However, the problem that Pakistan is facing is that the IMF requires the country to change the way it's structured to ensure that it's on a firm footing and that it can move forward being self-funding and self-sufficient. Pakistan has historically been providing food and fuel subsidies as well as keeping taxes down to keep the cost of living low. However, the IMF is now demanding that these policies are changed before it will release the remaining funds available to Pakistan. In order to meet the IMF's requirements, Pakistan has introduced 170 billion rupee finance bill, which is roughly around 643 million US dollars, which includes increase in the general sales tax in the country from 17 to 18%, reducing fuel subsidies that are currently keeping prices at the pumps low, and introducing austerity measures for the government. The Prime Minister advising that all the federal ministers and government officers to reduce expenditure by 15%. He has asked all his ministers and advisors to forego salaries, allowances, luxury cars, foreign trips, and business class travel. The armed forces has given a positive response to cut non-combatant expenditure. The IMF recently visited Pakistan for a 10-day period to try to negotiate a final settlement. However, no agreement was reached as the IMF were not satisfied that all of the measures that had been put in place correctly. So the negotiations are still ongoing with regards to the release of the additional capital. As a result of the ongoing problems, both Moody and Fitch, the rating agencies, have recently downgraded Pakistan's debt status, with Moody slashing the rating by 2 notches to Caa3 and Fitch downgrading to CCC, and Fitch provided detailed feedback as to why this downgrade has been introduced. The first issue highlighted relates to liquidity and policy risks and states that the downgrade reflects further sharp deterioration in external liquidity and funding conditions and the decline of foreign exchange reserves to critically low levels. The shortage of reserves at 2.9 billion US dollars on 3rd February 2023 has also been highlighted, which is less than 3 weeks of imports. These reserves are down from a peak of more than 20 billion US dollars at the end of August 2021. Fitch have stated that the falling reserves reflect large current account deficits, external debt servicing, and currency interventions by the central bank, particularly in the fourth quarter of 2022. So in simple language, Fitch believes that the Central Bank of Pakistan were using its reserves to increase the price in the Pakistani rupee in the international markets. Fitch have also raised concerns about the IMF loan. Firstly, Pakistan's reluctance to introduce all of the measures that the IMF are looking for before the money will be released, and secondly, the fact that the IMF's conditions are likely to prove socially and politically difficult amid a sharp economic downturn. High inflation and the devastation brought by widespread floods in 2022, elections are due in October 23, and former Prime Minister Imran Khan, whose party will challenge the incumbent government in the elections, earlier rejected an invitation by the Prime Minister to hold talks on national issues including the IMF negotiations. The authorities in Pakistan have desperately been trying to put together a deal with IMF to release the additional tranche of funding. But there are fundamental problems in Pakistan that won't be solved by the release of another 1.7 billion US dollars from the IMF. The country is still a net importer. It's running a negative balance of trade. So therefore, it's constantly having to borrow more money to keep the country running. The existing debt Pakistan has built up and the associated financing costs are just unmanageable given the GDP of the country. The central bank in Pakistan have increased the interest rates in the country by 300 basis points from 17 to 20%. That is now the highest level since June 1997. If you've got any debt, the last thing that you would want at the moment is further interest rate increases, because that's increasing the cost of your borrowing and that's going to put more pressure on you either as an individual or a company or both. But the problem that the Pakistani authorities have is that the IMF is demanding all of these reforms are put into place before they dash out the money. So they don't really have any choice. So over the course of the last few weeks, we've seen fuel subsidies being reduced, which has increased the cost of fuel for all of the people in Pakistan. We've seen tax increases being announced. So that's going to reduce the amount of disposable income that everybody has. And with an increase in the interest rates means that the cost of living is going to go up in Pakistan at a time when standard of living is falling dramatically. Food inflation is currently running above 45%, which is an unsustainable level. So in terms of what's going to happen over the next 3 months, as we've seen from today's video, is extremely tough times for Pakistan. Pakistan will need to raise $19 billion for its international debt obligations. It simply doesn't have enough money to be able to make all those payments, and therefore Pakistan is going to have to renegotiate all of its debt facilities, and it's likely that Pakistan will need to ask all of its lenders to write off a large portion of the debt that it owes. That's the only way Pakistan is going to be able to get back, as otherwise it will be impossible for the country to be able to pay it back. Now, one of the really interesting questions here is what's going to happen with regard to debt that Pakistan owes to China. The Chinese authorities have actually negotiated leases on some of the lands, and the most famous example is Hambantota port in Sri Lanka, where the Sri Lankan authorities couldn't pay interest on that loan. As a result of the negotiated settlement, China took a 99-year lease over that port. That raised concerns in India, which is a very close neighbor to Sri Lanka and a very close ally to the USA. China could use that lease to set up a military base on that island of Sri Lanka. We don't know what discussions have been held between China and Pakistan so far, but there is a distinct possibility that the talks between the two countries could result in China taking similar leases positions over assets and land in Pakistan, which again could raise security concerns for countries like the USA and India. Let's not forget that Pakistan is actually one of the few countries in the world that actually has its own nuclear missiles, and given the rising tensions between the USA and China, that raises a whole new question. So hopefully you've enjoyed today's video. If you found it useful, informative, and thought-provoking, give me a thumbs up and subscribe to my channel for more of such videos.